Before we get started, what we're going to be talking today a little bit about price action, and in particular, I want to cover one of the most basic price patterns that we use over and over and over in price action trading, the 3-bar reversal pattern. It's the old reliable. It's the thing we always go back to. It's one of those, it happens frequently in the market, and if we can identify it, it's usually a pretty good setup for us. So we're going to talk through some of the particulars on the 3-bar reversal pattern today. But before that, I want to take a quick minute and introduce a challenge that we have here at the Apiary Fund. It's our what we're calling it the May Day Trade-a-thon. The May Day Trade-a-thon. It's the 1st of May, Tuesday, May 1st. And we're going to celebrate May Day. May Day is typically a spring celebration in the Northern Hemisphere. It's spring right now, and so there's a celebration that is often celebrated, especially over in Europe, called the May Day celebration. It's singing, dancing. They have this way cool. They do this little dance around a pole. Let me show you a picture here real quick, where they have this pole, and then they have these streamers that the children that they dance around, and then they braid this pole. They encapsulate the entire pole in this braid. It's really amazing, really cool. We won't be doing that here at Apiary Fund. While they're doing that, while they're dancing around the pole and braiding these streamers, we're going to be trading here at the Apiary Fund. We'll be celebrating it in our own way. But that's May Day, and what we're trying to do is we're trying to break a record here at Apiary Fund. Our typical day, in an average day, we're hitting about 50,000 trades a day. So 50,000 trades a day. On May 1st, our goal is to double that. We're going to try and hit 100,000 trades on May 1st. And so join us. We're going to be trading. We're going to do, on that day next week, we're going to do a couple of live streams, maybe some in YouTube, and maybe some in Facebook, where we talk a little bit, kind of show the different trades, and we'll trade live with you a little bit here and there, and we'll kind of track our progress and see how fast we can hit that 100,000 trades on May 1st. So make sure you join us next Tuesday. We'll put that on the Apiary calendar. And then also, for those of you who aren't with Apiary Fund, we'd love to have you come and join us and be part of that celebration as well. So mark your calendars for next Tuesday, May 1st, our May Day Trade-a-thon. Anyway, should be fun. Well, let's just jump into it. Want to talk a little bit about price action trading. One of the last YouTube lives, we talked a little bit about indicators and how important it is to tune your indicator to the market conditions, and we talked a little bit about how indicators are lagging simply because they're math formulas that measure data that's already come in to the market, and we're making decisions based on the results of these different algorithms that are constantly running in the market. Kind of the opposite side of that is an approach to trading called price action trading. Now, price action trading is just simply, you basically are just looking at the same data, only instead of applying algorithms to that data, math formulas that are processing that data, you're basically making decisions on how that price forms. And so decisions are made based on, what kind of trading activity is happening right now in the market, and we're trying to catch those movements as they form as new data comes into the market. We try and place trades based on what we see on the charts. Typically, if you look at someone who's sitting there trading, right, and you look at their screen and all you see is a chart, then they're probably price action trading. If you're looking at their screen and you see all these little indicators all over the place and different lines and squiggles and everything and different colors all over the place, then they're probably, using some sort of an indicator approach to trading. But let's talk a little bit about price action today. So, and in particular, what we call a 3-bar reversal pattern. So let's take a look at that 3-bar reversal pattern. And I would have to say that this is probably the old reliable in price action trading. This is like the first thing you have to learn if you're gonna be trading. One of the first things you want to learn if you're going to be trading just off price. But what is a 3-bar reversal pattern? So basically, what you have is anytime you're using price action, you're measuring the current candle, so this candle that's forming right now, to the previous candle. So you're measuring the current data to the previous data. So if this current candle, let me erase that real quick. So if this current candle has a high point that's lower than the high point before, and a low point that is lower than the candle before, then you would say that it's in a trending market. It's trending lower because the highs are going lower, the high right here is going lower, and the lows are going lower. And so that's considered a trending market. And so with the 3-bar reversal pattern, what we're trying to do is we're trying to find the turning point in the market, the point at which a trend, in this case a downtrend, turns and moves up. So it reverses direction. And so what we do, again, is we always compare the current data to the previous data. And what we're looking for in a 3-bar reversal pattern is a point where you have a series of lower, in this case, a series of lower highs and a series of lower lows. Highs are getting lower, lows are getting lower, and you have a candle now, the current candle breaks that pattern. So it breaks the current trend of the market. We call this a 3-bar reversal pattern because we have 1, 2, 3 bars, right? So we have 3 bars. I bet we just had one of our support reps come in and look at Facebook, and I'm sure that that those of you in Facebook aren't able to see what we're drawing here right now, and so you're missing a little bit of it. If you want to go check out YouTube, if you want to go to our YouTube live stream, you'll be able to see the drawings that I'm making right now. Unfortunately, technology at Facebook won't allow us to stream the drawings on using their platform, so we're kind of stuck with that. So if you want to, those of you in Facebook, if you want to go check out what's happening right now on YouTube, you can see everything live in YouTube. All right, so we get this 3-bar reversal pattern, and it's 3 bars. So the way we measure that is that you've got the measure bar, the first candle is called the measure bar. So we just go down here. This is called our measure, because we're using that to measure. That's the last measurement that we have in the downtrend. The second candle is called the apex candle, or apex bar. And then the third candle is called your trigger. So that constitutes the 3 bars. You've got a measure bar, is this one. Let me use a different color. You've got your measure bar, which is this one. You've got your apex bar, which is that one. And then you've got your trigger bar, which is that one. So that's your 3-bar pattern. Now, the trick here is that you always, in order for this, the third bar to be a trigger bar, what it has to do is it has to break the trend. It has to form a higher high and possibly a higher low than the apex bar. So the apex will measure the pinnacle point. In real math terms, that's not an apex. If it's on the bottom, it's a nadir, right? So, but the concept is the same. So it's the lowest low point in that trend, and then your trigger bar has to form a higher low and a higher high than the apex bar. And that formulates the reversal pattern in your trend. And these are especially good because, you know, that the assumption is that now you've got the start of a new trend. So if you get into the market in using this trigger bar here, then presumably you're going to catch the next run, the next trend. It can be long or it can be short. You have no idea what type of trend will happen after the reversal pattern forms. But that's the idea, is that you're going to now catch you'll be right there in the right spot for the next trend movement higher. So let's erase all that and let's look at it the opposite direction now. Let's look at a 3-bar reversal top. That was a 3-bar reversal bottom. And so for 3-bar reversal top, you have to have an established trend, right? Where you've got higher highs and higher lows. So higher high, higher high, higher high, higher low, higher low, higher low. And we just keep using the current bar to measure against that. And then the point at which you break that trend, forming a lower high and a lower low, now you have your 3-bar reversal top. 1, 2, 3-bar reversal top. You've got your measure bar, your apex bar, and your trigger bar. So now if I'm going to trade this, it's kind of tricky. So that's what you're looking for in those 3 bars, in that just 3-bar reversal pattern. But it can be kind of tricky, and there's a reason why you have to wait for that trigger bar. And the trigger bar will form the minute that it crosses below the low of the apex candle. So the minute that the market crosses this point, that forms the trigger bar. That is the formation of the trigger bar. And so when you're trading this, what you typically like to do is place your buy order, or sell orders in this case, a sell stop or a sell order, underneath the trigger point, that trigger point or the low of the apex candle, because that's going to get you in at the right place to catch a hopeful downtrend in the market. Now, sometimes the market can trick you, so you'll have this nice trend form, right? You get an apex candle, and all of a sudden you get a lower high. So the challenge is that this new candle doesn't cross, the way I drew it here, doesn't cross below the low of the apex, right? In this case, this is the apex, but it didn't cross below the low. And so technically, what I like to think, how I like to look at this is that this candle never happened. It doesn't have any influence on the current price because it's completely contained within the apex candle. So neither the high is higher or neither the low is lower. And so I can just kind of assume that that candle has no real influence on future price action. And so I have to wait for the next candle. And if the next candle then forms like this, now you've got your 3-bar reversal pattern. This is bar 1, this is your apex, and this is your trigger. So it doesn't necessarily need to be 3 bars if that second candle doesn't form a higher high or a lower low than the apex. So you just kind of forget about that candle as having any real influence on the 3-bar reversal. Does that make sense? Hopefully that makes sense to everybody. And let me show you one more variation of this that you'll see often. one more variation of this is, so you've got your nice little trend forming. Now you're looking for the apex bar to form. In order for the apex bar to form, you have to have a lower low and a lower high. However, what happens when you get a candle like this? So we saw what happens when you have an inside candle in the previous example. Now we have an outside candle, right? Where it's formed a higher high and a lower low. Now this is tricky, right? In reality, what I look at is now this forms the new apex. And so this is now your measure bar, your measure bar, your apex bar. And in order for the market to form a true reversal pattern, it has to cross below the low of that apex bar. A little bit trickier, when you see this pattern form, it's a little trickier to trade than your nice standard setups, because you're like, oh my gosh, it's going higher, but it's going lower at the same time. I don't know what to do. And so oftentimes, I'll just wait for it to form, to cross below the low of that new outside range. And that can be a fairly effective trade as well. So the crux of these patterns, this is what's important to remember. Always look for the trend, a series of candles that are trending before you look for the apex bar. That just makes sense, right? The 3-bar reversal pattern only forms at the end of trends, right? So that's the first tip. The second tip, number 2, is to look for the market to drop below or above the apex candle. So you're looking for that trigger point to happen. So nothing really forms until it crosses the trigger point. So always remember that. The trigger point being the low of the apex candle in a top reversal pattern, or the low or the high of the apex candle, in a bottom 3-bar reversal pattern. So just always make sure that you're looking for it to cross that point. The final thing is you place your orders to get into trades when it crosses that trigger point. Now, as with anything, there's a million variations of this pattern that you'll find, and I showed you two common variations: an inside candle, and the way I look at analyzing inside candles is I just assume they don't have any influence on the 3-bar reversal pattern, so I can just kind of forget they existed in a sense. And then the outside candle, which is this last example we did here, and in that case what I look for is the same thing, only I use the outside candle as the new apex. So I just shift everything towards the new apex. So hopefully that gives you a couple of things to practice in your trading this upcoming week, and especially next week when we do our May Day trade-a-thon on May 1st. We'll throw in a few 3-bar reversal patterns and hopefully make some money on those. Great to be with you today. Hey Dave, do we have any questions, any comments from any thoughts, anything I need to clear up? I can't see any of the comments that are coming through.
So Danny Goodman asks, what is there other candles in between these in a larger example?
Candles, any candles in between. So sometimes, yeah, everything, Johnny, great question, by the way. He's asking about noise, right? I drew this pattern so beautifully. When you're sitting down trading, you never see the market form like that. Nothing is beautiful in the market. And so sometimes you get tails, sometimes you get a wild candle, and then it's right back to the races. So I always use that. I always try and filter out outside ranges and inside ranges. So just remember that those two variations happen a lot in the market. if you got an outside range, you could easily see that market continue the trend. In that case, it's going to have to cross above the high of the apex. And so you're just looking at what direction does the market go after what you think is the apex. What do the next candles tell you? And you're constantly shifting back and forth. You're constantly measuring the current candle against the previous candle, always measuring that current candle. Good question. Thank you.
Richard asks, can you talk about tails versus bodies in reversals?
Great question. Tails versus bodies. Now, in these examples, I always used just body candles. I didn't throw any tails on them. But tails are technically, tails are also used. It's the highest point in a trading range. So let me just draw something real quick here. So sometimes you'll get a pattern here. Now I'll start drawing some tails. Like that. So this is still your apex because it's the high in the range, and that is still your trigger point. And even though that, we could have drawn this one, and so the body could be technically within the previous candle, but you've got the wick up on top, so you count the wick. Now, sometimes you have to use a little bit different filtering techniques, especially if the market is extra volatile, but we can address issues like that in more detail as we go into, especially in Apiary Fund, as we're refining price action. We can go into details and explain how to filter out that type of those extra candles, those extra wicks, and so forth. But for right now, let's just kind of keep it simple. Let's kind of look at the pattern. Let's learn to identify the 3-bar reversal pattern in our trades, and then we can start to learn how to filter out all that extra noise. Great question.
Jeff Peterson, where do you look for a 3-bar reversal to form?
Where do we look? Obviously, I think the ideal spot is you look for any 3-bar reversals in the past, right? Any turning points in the past are a good location to find these 3-bar reversal patterns. So let's say that we have a market that's formed a little bit like this, right? We've got a reversal, like this, right? So you've got a reversal pattern that formed up here that forms a resistance, one down here that forms a support, and we're getting a series of trends right here. I'm going to look for that 3-bar reversal to happen up in this area as opposed to this area. That's less common. That's a less common place to find that 3-bar reversal than that area up here. This is a better place to find it. This is a worse place to find the 3-bar reversal pattern. So obviously, if you could, I look for those 3-bar reversals to form where the markets have reversed in the past. So if we were coming down this way, I'd look for it to form, somewhere in that range down there. Excellent, Peterson. Jeff, right? Anyway, yeah, great question. Let's take one more, and then we'll.
Last one. Brandon Whittinghill says, how many candles do you let pass before on the 3-bar reversal before you disregard it?
Oh, good question. So I'm assuming you're asking the question where you've got that inside candle after inside candle after inside candle. And you'll see that a lot in the market. So if I'm understanding the question correctly, you got the nice trend. coming, you form this, and then you've got inside candle, inside candle, inside candle, inside candle, inside candle, inside candle. So same thing, I use it the same way, only this, so typically you've got an influx move and then a reflex move. You look at the market to go one direction, then reverse and go the opposite direction. And the reversal lets out a little bit of steam in the market. So it's the yin and the yang to the market, right? But sometimes it can let out steam by going sideways. And this forms what we call a consolidation, and love to talk about that in another episode of YouTube Live. But what I typically do is I put a line above that at the high of the apex and at the low of the apex, and then trigger points if it breaks above, and trigger points if it breaks below. So this wouldn't necessarily be a 3-bar reversal pattern, but it's still a very effective pattern to identify entry points, because the market at this point, it's just as easy for that market to go higher as it is lower. And so I still use the high and the low of the apex candle. Use the high and the low of the apex candle to identify entry and exit points. Great question. All right, traders. Again, mark your calendar. May 1st, let's get back here. Let's come back and let's trade a bunch on May 1st. Let's hit that 100,000 trade mark and see if we can create a new record here at Apiary Fund. So check out YouTube Live. We'll move that from Wednesday next week till Tuesday. So we'll move our YouTube Live to Tuesday, and we'll do a couple of live trading sessions during the day Tuesday. Look forward to it, and happy trading, everybody. We'll see you next Tuesday, May Day, Trade-a-thon.